What's going on, everybody? Welcome to SmartHelping.com. Jay here, and we're going to do the construction business financial model. A couple things I want to point out. Number one, the world is not ending. The world keeps turning. It doesn't matter what the media says. People are still doing business. People are busy. Um, things are not ending. So don't get caught up in that drama. Number two, um, on the construction business model, my focus is on making something that's the most useful. It's not going to be useful for everything, but it's going to be useful for the most useful thing that I think is relevant, which is cash flow planning. So we're focusing on cash flow planning on a construction business. That's the focus of the model. We'll get into that in a second. Remember, check out more financial models, templates, and tools at smarthelping.com. You can get everything I've ever built for $9.99, and that's lifetime access and it includes anything I build in the future. All you have to do is ask for a refresh. I'll send you over the latest zip with all the latest financial models. You can also buy by category or individually. Uh, let's send out Twitter. Tell them we're live. Construction biz. Check our sound real quick. Check our sound real quick. Sounds great. Okay. Okay. So, where did we leave off last time? Uh, so what we're trying to do maximum flexibility but high level planning. So we're going to have with the construction business three general job types that the construction business can do. You can only choose one of them or both or all three. And in each one, what we're defining is the number of new jobs started per month over a forecasted period. You can define those manually over a 120-month period. I made this manual because it seemed too difficult to or not as useful to just do a percentage added increase in the growth per month. Um, Especially with the startup construction business company, it's going to be something where you're entering manually um, the new jobs. Or I mean, you could be doing hundreds of new jobs a month if you're a giant company that just wants to improve its unit economics and really drill down and tighten up the the financials. But anyway, either case, this is the best thing I could think of. So you can type in the new job started per month. You can type in the percentage of a job that's completed per month on average. Now, the percentage completed is going to drive a couple things. It's going to drive when you recognize revenue. So for the income statement, if this is the total value of a given contract, an average contract of this job type, 50 million, and you complete 25% in each of the first 4 months of the job, then you collect 25% of this 50 million as recognized revenue. Now that's not to say you've collected all the cash in each of these periods. There's other logic for that, which so this is the main change I thought of over the weekend. Instead of having, a 50-50, evenly billed, 100% up front, 100% upon completion, screw that. There's no need to try to have to code in four different scenarios. Here's what I'm going to do instead. We're going to say percentage job complete is a percentage, and then right below this, we're going to say the job value, and then we're going to put the amount of cash collected on the job, collected over job lifetime on average. So this, if it's 100%, if it's 10% up front, 0, 0, and then you know that these jobs take about 4 months, you put the other 90% there. So you can now structure anything you want here for these jobs. You could do evenly over the life and just make it the same as when it's the percentage completed. You could do 100% up front. You could do some other schedule, whatever your terms are. This is going to allow you to plan how the cash flow of the business is doing, as well as show a revenue on the income statement that's essentially matching using the matching principle where things are completed. And after the same, you can just make them the same, and that's fine. Uh, and that's going to solve some. That's just going to make the model better for cash flow planning. So we've got that dynamic. The main issue today that we're going to be thinking about is, and let me put this here so I could see this. The main thing we're going to be thinking about today is how do we plan out the expenses of each job when there's multiple jobs happening over time, and that involves possibly renting equipment, or you have to buy equipment and on a CapEx schedule, and that's going to have to be what you use over the life of the construction business. That will be later. Don't worry about that now. Um, for the CapEx, but we need to know variable costs. So that means on average for this job type, how many materials do you use? So this could be like concrete, um, what rebar, anything that you need to use, materials that you have to buy and then you use up and implement. Wood, lumber, all those kinds of raw materials that you got to use to build whatever you're building. So what you can do is you put an average um, cost of all that stuff per given job. Now, like I said, it's going to be an estimate on average. You're not going to manually input what you think every single individual job is going to be. You want to do an average because we're trying to do a forecast based on what you expect. What jobs are you completing? What does it take to complete them? What are all the material costs here? Now, on a separate schedule, you could easily put, a schedule and just list on average job type one has all of these different materials, and you sum it up and you just make this the total. That's fine. I might actually do that in this model. But I'm trying to keep it a little bit higher level to start off here. So material cost per job. Now the question is, when do you pay for those materials? Do we just tie it to the percentage that the job's completed? So if it's on average 5 million and you have 25% of the jobs completed here, of that 5 million, 25% gets paid out here, 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 and here. Or do we say another schedule that says, okay, over the life of the job, um, when cash is paid for materials, and then that will flow based on whatever percentage you put in here. So it could be 25, 25, 5, 5 here. So the job lasts for 4 months. You're going to spend this material cost, you're going to pay for it here, 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 and here. Or do you have some terms where you have it on account, so you only have to pay for, you can pay half in month 3, half in month 4 of the life of the job, which also could be a possibility. And I'm going to put notes on this that says this is the month or months that cash is actually paid out for material costs over the life. Wait. This is the month. How do I put this? This is when cash is paid out over the job life cycle in months. This is when cash is paid out over the job life cycle in months. So we have to put so this is month 1, 2, 3, etc. And this applies to all of this. We don't need to reiterate the month numbers multiple times. Let's bold this. So this month number applies to all of these, but it applies to them differently. So this doesn't mean in month one of the model you complete 25% of all jobs. It means in month one of each of the new jobs, 25% is getting completed, or whatever the percentage is. And same with this and this. These are over the life of the job. All right, so we've got our average material cost per job. We've got what we're charging the customer, when we're collecting that, when we're paying for all the materials. Now, in theory, now we're not even going to get to that. This is fine. This is good. We're focused on cash flow. This is going to get you to cash flow forecast. Now, the other expense, we haven't even gotten into labor yet. Um, the other expense is equipment rental. So many construction companies are going to have equipment rental costs. If you are renting your equipment for the different job sites that you have over time, you need to put your average rental cost for that. And that's you have to estimate, well, an average job takes, 3 or 4 months or 6 months or 12 months over that time. How much are you paying it for rental equipment? And then we have the same thing here. When cash is paid for rentals within job life cycle. Within job life cycle. And then for this one, it's probably, let's say you only need certain equipment for the first 2 months. So of that 1 million, you've got 40% hitting in month one, 20% in month two, 20% in month three, and then in month four, maybe you have another 20. And so that will then spread out your cost for equipment over time, which is just a general and administrative cost. This is well, technically, so this is definitely materials would be a variable cost. Um, Equipment rental is just a general cost, but they're kind of all variable because this is scaling based on the job count. Uh, so I might, in the income statement, I might group all these together in as a variable cost and then put a contribution margin as, nah, I don't know. I think it's actually, this is equipment cost is going to go into general expenses. Materials will definitely go into variable costs. Let's look real quick. Let me look real quick at a construction business income statement. Just let's see how they set it up. Income, yep, contract revenue. Okay, okay, so cost of construction is what they put it as, and then gross profit, so that's fine. So we'll have labor, materials, subcontractor and labor is going to be the same for us. Miscellaneous, payroll taxes, insurance. Okay, that's fine. Yep, that'll be included in there. Okay. And these are just generals. Okay, so cost of construction, that's fine. That makes sense to me. That's a good one. All right, perfect. Um, Now the question, so they have adjustments. Since you're just estimating the value of the contracts, it's not really like if you're doing an actual income statement of actual data that you've had, it's not gonna matter what your what this number like this is gonna be what you build out, like you'll have accounts receivable, payable, and all that, unless you're on cash basis. You'll either way you'll have like the amount you're billing, and then you might have adjustments to the job. This is saying what do you expect that in the end, what do you expect to be collecting from customers on each job? What do you expect to be paying in these costs? So that's perfect. This is fine. The trick is making all this dynamic, which we're going to have to do with matrix. tabs. So percentage jobs completed per month, average value per job, materials, equipment. Now the other thing is now we have these hourly wages. So for hourly wages, we have on a given job, what's the head count, what's the total hours worked, what's the average hourly rate, and then what's the average increase in hourly wages. So this is going to be pretty complicated, and um, we'll have to spread the total hours worked per job evenly over the life of the job. Um, Now let's think about this. So we have labor. These also could be worker types, could be subcontractors or not. The difference is going to be, are they subject to payroll taxes, which we can put here, payroll taxes, benefits. Now this is different than like general managers, which will be on a different area. But here for payroll taxes and benefits, you'll have a percentage, and it could be some percentage. If it's a contractor, then it could be 0%, like subcontractor. Maybe their rate's higher. Whatever the case is, you just estimate on average for each of your jobs that you do, what what does the labor count look like? How many hours are individuals working on a given job? And then based on how many jobs you have, will show, if this is going to be, let's see, because there's going to have to be some capacity. Like if you have this many people working, 15 people, and you had like 100 jobs starting every month, obviously there's not going to be enough coverage. So there's going to be some math that happens here to help sanity check the assumptions. Um, so we'll get into that once we model this out, but we're going to have to make all this dynamic. Like these costs are going to have to be, we're going to have to build schedules for all this. Now, I believe this is enough. Which, let's see, when cash is paid for rentals within job life cycle, when cash is paid for materials within job amount of cash collected over the job lifetime. Let's just make this term the same, life cycle. Okay, and we might as well, let's just do this here. So we can put construction cost detail, and we'll put in might as well just do this right up front. Let's say average material costs per job. And this will all just feed into the assumption of the average materials cost here. But instead of this being an input, we'll make it a sum of what we enter here. And this is just more for the user of the financial model to see, well, what are your material costs on average? Like, what does that make up? What is that comprised of? And we can make this quite long. just drag it there. It's better to be longer than not. So we'll put material cost description amount. So we have this. We'll also do the rental for equipment rental. Item 1, item 2, etc. So you could define all these names, and the total will be up here. Now what's going to get really cool is when we start building the dynamic logic for the amount of jobs completed and how we make all of this stuff work on a dynamic level. Let's just put 10,000 on each of these. So we have an amount here that will feed into this. So you can drill down into that. We'll do the same exact thing for rent. Average equipment rental costs per job. And same idea here. So you have item 1, let's say it's a backhoe. You have the average job cost is going to take 5 months. Let's say of those 3 months you got to rent a backhoe, type in the 3-month rental cost there, etc. And you can do that for up to, what we got, 82 items here. We'll freeze these top rows so you can see the totals as you scroll. I think that's good. That's useful enough. We're drilling down into the different items. Maybe these are 5,000. And again, we enter when cash is paid for these rental costs, and the percentage is here, and the maximum flexibility is just have a percentage for each of these items. Now this is likely just going to follow the percentage of job completed, but it might not. Like if you say, well, if they're going to give you a deal, if you pay for all the rental costs up front, then maybe you pay 100%, maybe you're getting a discount. So, or if you're paying it on the end, that's fine too. And whatever the terms are, this is going to define your cash flow. And again, I want to focus on being accurate in the cash flow forecast as the most important thing that the model is going to be able to forecast, because I think that is the most important thing to have accurate, um, especially with the scaling model like this. All right, so percentage of completed. This goes to that. Then we'll reconcile it with the cash. Materials when that's paid for. Equipment rental when that cost is paid for. And this will be every time there's a new job started, all this logic starts in. And then we aggregate it. We'll aggregate it by month. Now what's tricky, we'll have to figure out how we do this labor and subcontractor stuff here. This will be interesting. But I believe we've hit everything that's going to have to be dynamic and everything that's like variable based on the job count. I think we've tied to something that's relevant. I think we can start building out the matrix for this, which is going to be pretty cool. So first, we obviously need to know the age of each new job that's been started and when it started. So we'll do that here. So this is some of the most important logic I ever do. It's how you make things dynamic in models. I've been doing the dynamic matrix stuff for quite a while, and it's just so useful for so many different use cases. And when people are modeling, they end up if they don't know how to do this, they're going to do workarounds that make it less accurate and don't allow to really see what is actually happening and when it's happening when you have dynamic nature like this. So this is really important. So what I'm going to do, well, we need a monthly detail here. On the monthly detail, let's just throw in, this is not super unique. I just need the top section. I'm just going to paste in this format here from another template. So I just need this top part. And this will be a 10-year model when I'm all done with it. All right, and that will be the date here. Oh yeah, we don't need this anymore. Okay, so all I need is actually, I don't even need to get into this yet because look at, we have if, now here's the tricky part. Here's the first set of logic to figure out the age of each job and how many are there. So we go if let me think. It's even tricky. Just I haven't done it in a couple, month or so, so it's tricky. Let's see if this equals our job count here, then give me the job started per month here. Okay, let's try that. I believe, and we lock both of these going down. Yep, perfect. Okay, so let's say I start 0 in month 1, I start 2, 0, 0, 3, 1, whatever you think your schedule is for starting these new jobs for job type 1. And we're going to have to do this for all job type 1, 2, and 3. So we have our job started per month. This matrix is going to tell us dynamically when in our timeline, how many there are here. So we drag this out on the first 120 months matrix and down. And then we want to count so we know how many jobs were started and when. We now need to put the age of each job because all the logic's tied to the age. So we go age of job. And this just is going to say if this is greater than 0, then 1. Oop, greater than 0, then 1, otherwise 0. Then we come on over and then wrap this around if B124 is greater than 0, then B124 plus 1. And that is our count technique. I've used this for all sorts of models and all sorts of use cases. So whenever this job starts, we get a counter. And then we can now dynamically reference that over time with all of our other assumptions. Which is pretty awesome. I don't know if we'll need a year count, but I'll just put it up here. Perfect. Okay. So we have the count of jobs, we have the age of each job. Now let's actually look at the first. So the first piece of logic I'll do is revenue recognition and revenue collection. And you can see with this logic how this is going to work now. One second. Let's look up something here. And it shouldn't be too hard to build this out. Once we do it for one job type, the other two will be pretty straightforward. Sorry, I'm just looking at something real quick. Okay. So we now have the age. There's going to be a lot of index and match going on here. We'll do, let's see, revenue earned first. So this will be simply index, percentage job completed per month. This match the month here with this. And actually, sorry, we don't need to match this one. We actually match the dynamic month down here. And that can move. We don't want the matrix label in there. This stays locked. And so does this. So there you have it. Look at that dynamically. There's your 25% in each period. Then for the next job and the next job, so you can see how they stack together. And that will drive a lot of stuff here. So this is revenue earned. And we'll multiply that percentage simply by the total contract value. Let's extend these out a little bit so we can see what's going on. So we're earning 12,500,000 in each period as based on the percentage of job that's completed in each month. We can see each monthly cohort. Oh, the other thing we have to do, so that's only a single job. We have to multiply this by the job count. So times, and then to get that, we'll just do max value of this. And we can lock these two, but let the numbers go down. And you can see these will double now. So 12.5, you'll earn 25 million because it's saying you've got two jobs started, and in month one you complete that 25% of two $50 million jobs. So each row is a cohort of jobs being completed. And then you can aggregate these each month to get the totals, and this is how the magic works. All right, so we have that. And again, we can have three different job types too. So this is only going to be job type 1 that we're modeling. We'll do two more. That's earned. We also need to reconcile that with the actual cash collection. So the earnings will be zeroed out, and then we'll add in the actual cash collection here, which is going to be the same logic. So let's put this up. We want to multiply this, and then this we want to be back up here. So the same formula, except we now, instead of indexing completed job percentage, we index cash collected. So there's our reconciliation. So we go index 12. And now when we do this, you'll see, oh, there's 100 million on these two jobs. We collect 10 million up front, 90 million at the end. And that would change if you change this to say, let's say it was 10, 10, 10, and then 60. You can see how this is now 10, 10, 10, 60. And these are two jobs, 50 million each, so that's why it adds up to 100 million. Okay, so that's great. We drag this up and over. So we have revenue recognized. We have cash reconciled for when that's collected. We now need to do costs. So we did this is good, this is good. So average material cost, same exact logic, but we use C15 in here. So I'm just going to copy this here, and this is going to be materials paid for. And again, let's sum up all these because these are all aggregate totals that'll go into the monthly P&L detail. All right, cash collected, revenue earned. Now we have material costs. So this we go to C15 and 16. So 16, here's the percentage, and then multiplied by C15. And then we also drag this up to the age and drag this up to the max job count or the jobs count per job type. So here 1.64 million in month 4 and 5, but that's because this job doesn't start till month 2, or is when we have these two jobs starting. And then when do we pay for them? Month 3 and 4 of the job, which if you start in month 2 is month 1, 3 is 2, or month 2 is month 1, 3 is 2, 4 is 3, 5 is 4. So in month 4 and 5 of the model, we're paying for month 3 and 4 of this job, half of it each. So there's 4 and 5 of the model, and then you've got your next job, and when those are paid for, so the last 2 months of each, the life of each job. Okay, And that will be dependent on the job count, the material cost, and when those are material costs are paid for within the life cycle of the job. So remember this, the monthly timeline is used for all these. Um, the only thing that actually flows through time with these months as the model months is the job started per month. These percentages are all based on the life cycle of the job, depending on when the job started. Okay, so we have materials and then we have equipment rental. Just making sure this is all still working. So on here we go C16 and 17. Then pull this up to the age. Oh, and then that's based on, what would you, 40, 20, 20, 20. Okay, so that's going to give us all the main cash flow items we need. There's still uh, labor and subcontractors to do. Now this, I'm trying to think of the best way to do this, and I think we do a couple matrix sections, one that shows the total hours. First of all, we have to weight this. So we can get the weighted average by doing some product. We want the hourly wage against, well, hold on a second. Let's see. We have head count and we have average hours worked. I'm thinking about the best way to scale this because it'd be nice just to total up everything. So you've got 300 hours across 15 people. Well, no, technically you've got multiple people in these, so there's more. How do we do this? Also, these payroll tax and benefits, we do need those. We need this. What is the best way to do this? I don't want to put, I can't put 10 different matrix sections for each individual work type. I need to figure out a way to aggregate all this data into one number that then scales based on the job count and the percentage completion. So that's a little pickle here. What to do? And this hourly wage is a weighted average, including overtime. So you just do an estimate of how much time in a given year do they work overtime hours, how much time is regular, what's the overtime rate, what's the hourly rate, and you just do a sum product between the two, divided by the count. Actually, I'll probably have to add that in as a helper. Average overtime hours per year, average regular hours per year, rate, and we can do this for each one, actually. Regular rate, overtime rate. So this will basically give you a breakdown of the average amount of money they earn on any general hour of work. So let's say during the course of a year, they do 1,600 hours of regular and 300 of overtime. And it could be different for each type. And obviously it could be different than that. And your regular rate, let's say it's 22 overtimes 32. I'm just putting in random numbers here. Then your average rate would be sum product of these two and these two divided by sum of this. And there is your weighted average. So that means on any hour that's worked, on average, you're paying $24 an hour. Now, it's not going to differentiate between each job. We're assuming the average job, average hours worked per job is this. But remember, we've also got, why isn't this working? Oh, shoot. Let's clear this out. The average hours worked per job is this. There could be multiple jobs going on at the same time, so this is not really going to tell you how many overtime hours there are. Also, why is this not formatting over? Oh, there we go. But we can measure this against the amount of workers. We could say, well, hmm. So this is a very tricky problem too with the man hours. Let's say we have, 2 jobs started in month 2, 3 jobs started in month 5, and this is our percentage of completion of jobs. So in theory, 1, 2, 3, 4. In month 5, you're going to have 3 jobs you've started and 2 jobs you're still finishing up. So that's 5 jobs going on in month 5, which would technically mean you have, let's see, this many hours in month 5 being worked. Just trying to think through this. You got 450 labor hours happening. Across, you know, this times 5, across 75 people, which ends up, that should actually equal our that equals 6. I don't know if this makes sense. Because we're going to use the job count times this. I'm trying to think of a way to scale this that makes sense. And I don't want to get too granular. Like, I don't want to have to say, these two jobs are going to require this amount of hours. These jobs are, we can't separate every single job because this is a forecasting model. You might as well just sit down on a piece of paper and put every single job and detail it out, that's not what this is for. We're trying to build a cash flow planner based on the general attributes of a given job. What does the cash flow look like? So this here is where I'm stumped. And we've got good logic for the average rate, including overtime, based on the average hours worked per year of overtime versus non. What we're trying to figure out is we're defining a head count for each worker type or subcontractor for each job. So we should know how many there are over time. We also need to know the average hours worked per job. So if there's like a job here and then a job and there's not another job for a while, like you do, let's say you only do 2 jobs every, couple months, like 6 months or 7 months. So during this time, you have essentially 2 crews going at these rates, and they're only working 30 hours for an entire job. Now, if your job takes longer, maybe these hours go up. So that's why this is not directly tied to this overtime, these hours here. These are just on average what you expect per worker, and these are on average per worker per job. Now, they should make sense because they should be based on the same data. So when you go to figure out what this is and this, it should make sense together because it is just reality of what the average job takes. So again, 30 hours spread over 7 months means a given worker is only making, 30 divided by 7. They're only doing 4 hours a month. Now, if this were 120, or let's say 240, if it were 350 hours, so let's think through this part of it. If the average worker worked 350 hours for a given job, and the average job lasted 7 months, they're working 50 hours per month. And then that should kind of make sense with what you've got going on over here. Okay, so that jives, that all this logic is relevant. I'm just making sure the logic we have is relevant before we start making it dynamic. So based on the job count and the percentage job completed, we're basically going to have a multiplier here to figure out how many job fractionals are happening in a given month. And then that will multiply by, so this 350 multiplies by this percentage. Now again, if these were 8-month-long contracts, this percentage would be less. It wouldn't be 25, 25, 25. It'd be whatever 1 divided by 8 or 7. Or whatever it is. You could put whatever percentage you complete each job, how long it takes to complete the job on average. Driving that here, because this is going to drive the labor costs. So we multiply that job count times head count required per job. times the hours times the weighted average hourly rate. So if I have this, I need to distill this down into smaller numbers. So we need to say this is the total hours per worker type. Let's do it this way. So for this worker type 1, you've got 2 here. So that means worker type 1 is going to have 700 hours. The cost is 700 hours for a given job on average. Their average rate is $24 per hour. So if we multiply this by this, we have, here we go, the average cost. This is perfect. This is perfect. So now you have, here's all your worker types. Here's the total hours for a given job that are spent. Here's the cost of that. Now we're going to have to build a matrix for this that has the wages changing by X% each year. But that's okay, we can do that. And then we'll apply this to the cost as well. But we can now say, on average, a total job will cost $126,000 in labor or subcontractor, not counting the payroll taxes and benefits, which will be added on. I mean, we could do it here. We could just say this times this is that, and it's a second item, and in total you've got, 143,000 if you include that. Okay. So this is good, and then all I have to do is take this total, take these two totals, and multiply it by the average job completion per month, which is going to be the job count times the percentage. So if I have 2 jobs started in month 2 and I complete 25% of them each month, I do 2 times 126,000 times the 25%, and then that will get eventually the full 126 for each job. We'll get the payroll tax and benefits. So this is this. Oh, I froze this into 2. Okay, hold on. Okay, so this works great. This is awesome. Total payroll. So every job, here's your total wages, here's the payroll tax and benefits. We simply multiply that total just like we did with these totals here. So like you're collecting $50 million for a job, you're collecting it at these percentages in month 1 of the job, month 2, 3, and 4. You collect that amount, you pay the materials and equipment costs based on these schedules, and then based on this completed amount, we pay 25% of this total in month 1, 25% of this total in this total month 2, etc. So we can scale that dynamically. Now I'm going to do some helper calculations to show you basically how many Well, if you see, if this is per job, so you can see how many total crews you have going at once, I guess, and that will be based on the job count started here and how long it takes you to complete a given job. So that's pretty awesome dynamic, I think. That's like being able to say, okay, over a 120 month period, here's how many jobs I start in each month. Here's how long it takes me to complete a job on average, and this could be any percentage over however much time. And I can say based on that, here's how many workers I have working at any one time, and here's what my monthly cost is based on. Now, the assumption is you're paying the payroll taxes and benefits and labor in junction with this average hours per job, average hours a given worker works per job, times the workers of each worker type required per job against their weighted average rate. So let's label all this. This is total hours per job type, and this is grand total. Give this a space here. Okay, I'm pretty happy with this because we can scale in the matrix with these job counts and all the logic we did up here. We can easily scale these two numbers instead of trying to do it with 10. So the easiest way to think about it is let's say we start one job a year. Let's say there's just one job that happens in the year and it starts in month one. Okay, you do, this is the percent completed in each month. You're collecting, let's say 10, 10, 10, and then at the end, the rest. Here, let's say 50% up front, 50% at the end, and rental cost, let's just assume is same as completion. Okay, so you'd have this coming in each month. You'd have these going out each month based on these amounts, plus this amount going out against this percentage each month. And in the end, you'd have 50 million minus this cost, minus this cost, minus this. So you'd make 48 million profit before general overheads per job. And this is spread over, a year. So in theory, it's what, 4 million a month. Now again, that's just arbitrary based on these assumptions. You probably, if that was the case, 50 million in billings, you probably would have higher, and now you're looking at a full year's worth of time. So you probably have, let's see, 1900 hours worked since one job last year. Yeah, so these costs are going to go up. The rates here, and then maybe these construction costs are a bit higher since it's a full year's worth. So you would have to adjust all that stuff to make it make sense. But you see the idea, and this will all work based on any job count, arbitrary amount here, and it's pretty cool. All right, so now it's just a matter of building all this. I'm taking a break for today. It's 11:04. It's Friday. It doesn't even feel like a Friday. I've been on a bike trip from Tuesday to Thursday. Um, we stream Monday, Friday. Next week we'll probably stream Monday and Tuesday, continuing on with this. Remember, you can check out more financial models, templates, and tools at smarthelping.com. The industry specific bundle is where I will have the construction business template that I'm working on now when it's done. Thinking about pricing, probably $75 one-time fee. And remember, you can buy all the templates I've ever built, which I've been building these things since 2016. You can buy everything for $9.99, and that includes lifetime access to anything I also build in the future. Just ask for a refresh, and I'll send you over the latest zip. All right. Well, that's all I got for you today. We'll continue on building this model tomorrow or Monday. And today was great. This was probably the most important progress we've made on this, and now it's just a matter of scaling it out to 2 other job types and then building out the wages. That will also add some fixed cost stuff later, and then we'll wrap it all around with a 3 statement model and some exit assumptions and all that sort of fun stuff. All right, take it easy. See